What if I told you there's a war being fought on Wall Street, right now? Not with people, but with algorithms. A war that's measured in microseconds, where the winners and losers are decided by, literally, the speed of light. That's exactly what we're getting into today, the wild world of high-frequency trading, a technological revolution that really shook the financial world to its core.
So, let's set the scene. The day is May 6, 2010. The stock market's just humming along, everything seems normal, and then suddenly, things go completely haywire. In just a few minutes, the Dow Jones Industrial Average plummets nearly 1,000 points. At the time, it was the single biggest one-day point drop in the history of the Dow.
I mean, just try to imagine that. You're watching the retirement funds of millions, maybe your own savings, just vanish. In the blink of an eye, almost $1 trillion in value was just gone. Poof! And then, and this is the crazy part, just as mysteriously as it all started, the market snapped right back, recovering most of the losses. The whole event got a name, the flash crash.
So you can imagine the flash crash left everyone completely stunned and frankly terrified. It was this massive wake-up call that exposed some really deep flaws in how our markets were built, and it raised this one single terrifying question. What on earth was powerful enough to bring the entire global financial system to its knees in just a matter of minutes?
Okay, let's get into it. In the aftermath of the crash, investigators from the SEC all the way to the FBI started zeroing in on this powerful and pretty misunderstood force, high-frequency trading, or HFT. Now, they found it wasn't the single cause of the crash, but it might have been like pouring gasoline on the fire.
So what is HFT, really? Part of the problem is there's no single legal definition for it, but the SEC gives us a really good working description. Basically, it's using these incredibly fast and sophisticated computer programs to make a massive number of trades in ridiculously short periods of time. We're talking millionths of a second. It's kind of hard to even wrap your head around that speed.
And that brings up a really crucial distinction we got to make. Algorithmic trading is a super broad term. It just means using a computer program to help you trade. But HFT, that's a very specific, highly specialized subset. Think of it like the Olympic sprinting of the trading world, where the entire game is about one thing and one thing only: speed. The whole obsession is minimizing any possible delay, what they call latency.
And, well, that obsession with speed kicked off a full-blown technological arms race on Wall Street. You had firms spending hundreds of millions of dollars just to shave a few microseconds off their trading times. Why? Because in this world, a microsecond advantage can literally be worth a fortune.
So how do they actually get this speed advantage? Well, it really boils down to three key things. First up is colocation. HFT firms pay the big exchanges, like the New York Stock Exchange, huge amounts of money to put their computer servers in the very same room as the exchange's servers. The shorter the fiber optic cable, the faster the trade. Second, they buy direct data feeds, which means they get market information fractions of a second before it goes out to the public. And third, they use these really complex custom order types that basically let them jump to the front of the line to trade.
Now, this whole race for speed created this massive debate that's still raging today. Has HFT made markets more efficient, maybe even cheaper for the rest of us? Or has it created a rigged two-tiered system where the speed demons with the best tech always have an unfair advantage? Let's take a look at both sides of the argument.
It's really two sides of the same coin. On one hand, supporters argue that HFT is a fantastic innovation. They say that by trading so much, so often, they add liquidity, which just makes it easier for everyone to buy and sell. And they narrow the gap between buying and selling prices, which is called the bid-ask spread. All this, they claim, lowers costs for every single investor. But as you can guess, critics have a very different take. They argue HFT creates phantom liquidity. It looks real, but it vanishes in a puff of smoke the second the market gets shaky, like it did during the flash crash. They say it creates an unfair two-tiered market and seriously increases the risk of another system-wide meltdown.
And these criticisms get pretty specific and pretty serious. They're allegations of what's basically a legalized form of front-running, where HFT firms can detect a big order coming from, say, a pension fund, and they race ahead of it to buy up the stock and sell it back to the fund at a higher price. Then there are manipulative strategies with names like spoofing and layering, where firms place tons of orders they have no intention of actually filling just to create a false impression of supply or demand and trick others into trading.
But here's where the story takes a fascinating twist. Right around 2014, just as the public outrage against HFT was hitting a boiling point, the easy money was already starting to disappear. You can see it right here on this chart. Profits just collapsed from over $7 billion in 2009 to just over $1 billion by 2014. And the reason? Simple: competition.
So many firms had jumped into the speed race that the profit margin on every trade became razor thin. The secret was out.
So, in the face of all this intense criticism, this was the official line. Back in 2014, the head of the SEC, Mary Jo White, pushed back really hard against this idea that the market was fundamentally rigged. She definitely acknowledged there were problems that needed fixing, but she also defended the overall integrity of the U.S. markets. It just goes to show you how complex and how contentious this whole issue had become.
And all that complexity, well, it forced regulators to finally step in and act. But they were facing this incredibly daunting task. How in the world do you police a market that literally moves faster than human thought? So agencies from the Department of Justice to the CFTC launched this whole flurry of probes and investigations to try and get a handle on it.
Yeah, the regulatory response really started to escalate pretty quickly. It started with that first flash crash report in 2010. Then one of the biggest steps was in 2012, when the SEC decided to create something called the Consolidated Audit Trail, which is this massive system designed to track every single order from start to finish. By 2014, pretty much every major U.S. financial regulator was investigating HFT, and it even went global, with the European Union passing its own first set of HFT regulations.
So what could they actually do about it? A bunch of ideas got put on the table. Some people proposed a tiny tax on every single transaction, just to discourage all the excessive, speculative trading. Others suggested a minimum time an order has to stay active, maybe just 50 milliseconds, to fight that whole phantom liquidity problem. And a really big one was the idea of creating a universal kill switch that could instantly shut down any trading algorithm that starts to go rogue.
And that really brings us to the fundamental question that's still with us today. Look, high-frequency trading isn't going anywhere. If anything, the technology is only going to get faster. The speed war that kicked off over a decade ago is still happening. It's just in a more competitive and more regulated environment now. So the challenge for all of us, for regulators and for the markets themselves, is to figure out how we harness the power of this incredible technology while making absolutely sure that our markets stay stable, reliable, and fundamentally fair for every single investor out there.